Imagine waking up with perfect knowledge of every stock that will succeed over the next 100 years. You know which companies will grow, when the market will crash, and exactly when to buy and sell. Becoming rich should be easy. There is only one problem. You have awakened in 1926. You pull out your phone, open your investing app, and discover that your phone is now a useless rectangle. So how would you actually invest? You might assume investing in 1926 was modern investing with more paper and slower technology. The reality was much stranger. Small investors were nearly invisible. The market opened on Saturdays, and the supposedly safe money in your bank could disappear. Let's travel back 100 years and attempt our first investment. First, we need a broker. There is no investing website, no open account button, and definitely no free stock for inviting a friend. You would visit or contact a brokerage office. Inside, customers watched prices arrive through a stock ticker. Imagine an extremely slow financial live stream printed onto a strip of paper. A clerk might copy the prices onto a giant board while customers watched, exchanged rumors, and tried to understand the market. Wall Street also had a 6-day work week. The New York Stock Exchange generally traded from 10 in the morning until 3 in the afternoon on weekdays. It opened again from 10 until noon on Saturdays. Apparently, losing money 5 days a week was not enough. Once we reached the broker, another problem appeared. The market was designed around blocks of 100 shares. 100 shares made a standard round lot. Anything smaller was called an odd lot and went through a separate system. Small investors could buy fewer shares, but they could face an additional price difference on top of the regular commission. Consider US Steel, which traded near $138 during 1925. A standard 100-share block would cost $13,800. If you lacked that much money, Wall Street had a special category for you. That category was essentially the person who cannot afford a normal order. But this is where things become truly strange. The public ticker normally reported transactions involving 100 shares or more. Smaller odd lot trades were omitted from ordinary volume totals. In November 1925, one active day appeared to have approximately 2.8 million shares traded. After accounting for missing odd lots, the actual total was estimated near 4 million. More than 1 million shares of activity could be absent from the number everyone was watching. Imagine purchasing 20 shares today and learning that your trade was too small to count. The ticker was not simply slower than a modern screen. It presented an incomplete version of reality. Prices also appeared in fractions. A stock might trade at 42 1/8 instead of $42 and a few cents. 1/8 of a dollar sounds tiny, but across 100 shares, it equals $12.50. Now, suppose we wanted to avoid individual stocks and purchase the entire market. Easy, we will buy an index fund. Except index funds did not exist. Even measuring the market was still a developing idea. The Dow Jones Industrial Average contained only 20 companies in 1926. It did not expand to 30 until 1928. A broader standard statistics index followed 233 stocks, but it was calculated weekly. Modern investors become nervous when a price is delayed by 15 minutes. Back then, your broader market update could arrive with the speed of a family newsletter. A daily 90-stock composite appeared during 1926, but the modern S&P 500 remained decades away. When someone asked how the market was performing, the answer depended on which small collection of companies they meant. Diversification was possible, but its easiest modern tool had only just been invented. The first modern open-end mutual fund, Massachusetts Investors Trust, launched in March 1924. In 1926, the mutual fund was approximately 2 years old. It started with $50,000 and a portfolio of 45 stocks. Investors could continuously purchase new fund shares and redeem them according to the value of the portfolio. Diversified investing for ordinary people was newer to them than many digital assets are to us. After making our purchase, we would finally own stock. But ownership involved actual paper. Stocks were represented by physical certificates. Payments, certificates, and ownership records had to travel through brokers and clearing systems. Wall Street created the Stock Clearing Corporation in 1920 to combine transactions and reduce individual payments. It reportedly reduced settlement checks by as much as 90% and the required funds and credit by 70% or more. Wall Street's great technological breakthrough was someone asking, do we need to deliver every piece of paper separately? Certificates could still arrive late, become lost, or create settlement failures. Today, an investment appears in your account seconds after pressing a button. In 1926, your proof of ownership was a physical object someone could misplace. What if we lacked enough money to buy the stocks we wanted? This is where margin entered the story. As the 1920s boom accelerated, investors could put down around 10% of a stock's price and borrow the remainder. $10 could control approximately $100 of stock. Much of the financing came from call money. These loans could be renewed daily, but lenders could also demand repayment. Investors were purchasing long-term assets using money that could be called back almost immediately. If prices declined, the broker could demand more cash. If the investor could not provide it, the stocks could be sold. Modern margin remains dangerous, but federal margin requirements now exist. In 1926, they did not. There was also no Securities and Exchange Commission or federal system of standardized periodic corporate reports. Investors could examine newspapers, company materials, and financial manuals, but insiders often possessed far better information. Organized stock pools could purchase shares and then trade among controlled accounts. These wash sales created the appearance of heavy activity and rising interest. Outsiders saw the climbing price and busy ticker and assumed something important was happening. Once the public began buying, the pool could sell its holdings at the inflated price. The activity investors trusted as evidence could itself be part of the manipulation. Modern pump and dumps spread through social media. Their 1920s ancestors spread across ticker tape. Keeping our money in the bank might sound safer. It was not necessarily safer. Federal deposit insurance did not exist. Approximately 615 American banks suspended operations in 1925. In 1926, the number was approximately 970. Many were small rural banks, but their customers could still lose access to their savings. Investors were not choosing between risky stocks and completely protected cash. The safe part of their portfolio could also disappear. Yet the strangest difference was how people thought about stocks. Respectable long-term portfolios were traditionally dominated by bonds, mortgages, and real estate. Common stocks were often considered too speculative. In 1924, Edgar Lawrence Smith published Common Stocks as Long-Term Investments. That title sounds obvious today. At the time, it challenged conventional wisdom. Buying diversified stocks and holding them for decades was not boring financial advice. It was an emerging and controversial theory. So, was investing harder 100 years ago? Information arrived slowly. Small trades cost more and disappeared from market statistics. Ownership relied on paper, manipulation was difficult to detect, and even cash carried serious risk. But those investors were watching modern investing being invented. Mutual funds were new. Broader indexes were still being constructed. Long-term stock ownership was becoming respectable, and clearing systems were learning to manage a growing financial world. Investing feels simple today because an enormous invisible system handles pricing, ownership, disclosure, diversification, and settlement for us. The phone is not the most important invention. The real invention is everything happening behind the button. Which parts of investing that seem completely normal today will look primitive 100 years from now?